Hey, good morning and welcome back, everyone, to our Monday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play, and markets are back near all-time highs. A little bit of jitteriness this morning with regards to some rhetoric around potential tariffs, but let's take a look at where we currently stand in terms of equities and how we are viewing the outlook based on the charts. So, like I said, on the S&P 500, what we've done is since the election, we've broken out to new all-time highs. We've came back to retest that breakout level as support, and we've now traded back towards those previous highs as resistance here again. We're testing those levels as resistance. Like I said this morning, we are opening up potentially a little bit lower here. This is due to, like I said, some rhetoric around the tariffs, but at the moment, if you look at kind of equity markets, they still look a little bit strong here. So the expectation, the base case here is that we make a new crack and a new 52-week high and potentially continue the trend that we started since the election. You see it on the S&P 500, you see it on the Nasdaq 100. We broke out to new relative highs, came back to retest this as support, and now we're back towards testing those all-time highs on the Nasdaq 100. You see the same thing here on IWM, broke out to new all-time highs, came back to retest these levels of support, and now on IWM small caps, we've actually already tested new 52-week highs yesterday. You see the same thing here on RSP, broke out on the equal weight S&P 500 index, and now we're already off to races with the new all-time highs on the S&P 500 equal weight S&P 500 index. So what we're basically seeing is a very similar setup across the board on major equity indices. We're seeing broad participation on this market rally here, which is largely supportive of a continuation higher here for equities. You have growth that has been outperforming value over the past, call it 2.5 months. We're seeing a little bit of where a value is starting to outperform growth here over the last couple of weeks. We've seen the small caps outperform the large caps, and that's part of what's driving this rotation back towards value away from growth. So we'll continue to monitor that and take a look at kind of what's moving and what's not. If you look at commodities continue to moderate here as gold and oil oil has moved off the 52-week lows. Gold has rallied a little bit here over the last week or so, moderating a little bit here yesterday. But overall, we've continued to see modern commodities perform relatively well. So this is one that we are still continuing to monitor to see if gold pushes back to new all-time highs and commodities continues an upward rally here. If you look at high yield corporate bonds, you see that the 50-day moving average continues to act as support. This continues to provide a risk-on environment from the bond markets, the high yield corporate bond markets, despite the fact that 10-year yields remain around just under 4.5%. The credit market is not particularly concerned about higher interest rates at the moment, and providing, like I said, a bullish backdrop here to equities. We'll continue to monitor this particular asset class for any potential shifts in concerns around credit risk. But at the moment, everything continues to point to more of a risk-on environment for risk assets such as equities and bonds. You have the VIX retreating back below 15%. This is a new level that we've seen here as the S&P 500 effectively reaches back towards all-time highs. These are levels that are more typical. We recently were having the S&P 500 make back-to-back all-time highs when the VIX were in the 20s. That was unusual, but the fact that now we're back around, below 15% is a much more normal regime for volatility, and certainly provides some opportunities to be long volatility in single stock names going into the next earnings season. So volatility back towards more normal levels, which gives options traders some opportunities here as well. The 10-year yield did decline here below 4.3% here over the last couple of trading sessions. We do expect that's going to tick up a little bit here again. But so far, it looks like that 4.5% level is the line in the sand that the Treasury markets are not going to pass. We're going to perhaps see a little bit of moderation here, but this could potentially be a bit of a peak here for yields, which would certainly be also supportive here for equities. You see treasuries, bounce off this $89 support level here. We've got a nice move higher here on treasuries. And the support the support here for treasuries gives us more confidence also in the overall bullishness that we've seen here from equities. You have the dollar index moderating below 107. 107 was the major line in the sand here. The fact that we've have the dollar peaking below 4.5% here on the 10-year yield leads me to believe that in the short run, 107 is going to be a major resistance level that holds on the dollar. We'll likely consolidate just below the 107 level here for a little bit of time, but longer term, the view here is that you're likely going to see some weakness here from the US dollar as yields continue to decline a little bit from that 4.5% peak that we saw here just last week. Gold, as you can see, after breaking out above its 50-day moving average, is back below the 50-day moving average around 2,600 or so. So we've seen gold kind of get really choppy between 2,800 and 2,550. But right now we're trading kind of within that trading range right now. And that's still my expectations here going forward, is that gold and oil retains much more in a range-bound motion than rather any particular directional view that we have for commodities. And then looking at the overall sectors, what's interesting is that technology as a sector continues to underperform after the election. So growth sectors such as technology are underperforming the S&P 500. This is something that we did not see in 2016. So this is one that we are continuing to monitor, especially in the semiconductor space, to understand, what is moving markets here at the moment. Because on the flip side, you have consumer discretionary that is outperforming the S&P 500, reaching new all-time highs and new relative highs to the S&P 500. This is supportive here for both consumer discretionary, but you also see it on communications. You have new all-time highs in communications, same relative outperformance alongside. You have financials breaking out to new all-time highs while outperforming the S&P 500 by a pretty significant margin. And then you have sectors such as industrials and materials also showing some strength here. Not back near all-time highs, so that's one thing to be aware of here. But you have both materials and industrials. As you can see, industrials did manage to break out to new all-time highs while outperforming the S&P 500. We also have energy stocks, outperforming here. We have pulled back here a little bit here yesterday, but effectively we got towards this $97 double top. We'll see how the market responds to this level, and if we start breaking higher here from 97, that would be a massive breakout of what would be a double top formation that would project XLE much, much higher going forward. And this is a bit more of a play from a regulatory perspective rather than oil prices perspective. The view here is that the incoming administration will likely be splashing regulation in the fossil fuel sector, and that has provided a bit of a boost here for energy stocks here at the moment. We'll see how long that can last. You also have home builders being a strong outperformer here in this type of market environment, because that 10-year yield peaking around 4.5% gives new strength here for home builders to rally. As 10-year yields continue to decline, we expect mortgage rates to decline with that. We also saw just last week housing starts the first positive reading we saw in terms of housing starts in nearly 4 years. So a bit of a positive environment for housing stocks. And if you look at the major home builders outperforming here in this type of market environment here right now. But on the flip side, semiconductors is really still one of the sectors that is underperforming here. As you can see, it continues to underperform the S&P 500. We've broken below some support levels. We're coming to retest this level of support. That is a potential opportunity to enter some bearish positions here. And note the severe underperformance of the semiconductor industry relative to the S&P 500. So a lot to add here. But to share with you some of the ideas that we have here for the week. Um, so some of the stocks that we continue to look at here, these are the ideas that we've been sharing with you over the past few weeks. Some of these are updates, some of these are new. Disney is one of the first ones that we want to bring up here. We continue to maintain a bullish position here on Disney. We've been bullish on this stock since the high 90s. We noted this kind of bottoming pattern that was completing, and we're starting to break out here. As you can see, we've gapped higher here and continue to move higher. Our upside expectation here is around 125 now to the upside in terms of our targets. And Disney continues to trade at a reasonable valuation relative to its peers, especially as it's expected to grow in line with the rest of its peers, but it is more profitable. And that's part of the reason why Disney, in my opinion, can deserve to trade at the current valuations that it's trading at the moment. Another one that we're looking at and have been looking at for quite some time here is Shopify. Shopify, we had noted this after it broke out here above 67.5 and came back to retest this level of support. We thought that was an opportunity to get long this particular stock. So far, the stock has really taken off since we've added this stock to our list. As you can see, we've broken out to new 52-week highs. Now we're retesting those 52-week highs. It does trade at about a 50% premium relative to its peers at the moment from a valuation perspective, but it is expected to grow head and shoulders faster than its peers, and is at the moment just as profitable as its peers. And so for those reasons, I think the valuations are are justified, and and the upside still is into that 140 area here to the upside for Shopify. Now, Intel is another one that we continue to monitor. As you can see, we've kind of formed multiple bottoming formations. The idea was that this double bottom completed its bottoming formation. We broke out above 22 and kind of traded in a range for quite a bit of time, broke out above 24. We're now trading in a range, and we're looking for that continuation higher here into that $30 upside target here from where we are. So Intel trading at a valuation that is roughly in line with the rest of the industry, but it is expected to grow much faster. Now that it's finished its restructuring and some cost-cutting measures, it's expected to return back to profitability here next quarter. So I think we are potentially well on our way of a bit of recovery here on a stock that has really taken a beating here over the past few years. Square, or also known as Glock now, is another one that we've been paying attention to here right now. We've been looking at this particular stock ever since it broke out above the $74 level here to the upside, broke out above, came back to retest this level of support, and now we're moving higher from where we are. Our upside target here is now in the 150 range, and it still continues to trade at a fairly significant discount relative to its industry, despite the fact it's expected to grow significantly faster than its industry. It is not as profitable as industry right now, but that is something that Square continues to work towards in terms of improving operating efficiency and returning cash to shareholders. And for those reasons, we continue to like Square as an opportunity here in the markets. In the retailing space, we continue to like Lululemon. Lululemon, we've kind of brought up since it completed this bottoming formation around 280 or so, and broke out above 280. It's just continued to grind higher from here. There's really plenty of upside opportunities here in terms of Lulu, but our initial upside target here now is around 350 now. That would be putting us in this particular range here up here. So we're getting very close to hitting our initial upside target here in Lululemon. It still trades at a small discount relative to the industry, despite the fact that it's expected to grow in line or slightly faster than its industry. But the one thing about Lululemon is that it is far more profitable than its peers. And so for those reasons, I think Lululemon at the very least deserves to trade in line with the rest of its peers. But right now it's trading at about a little over a 10% discount relative to its peers. So the upside potential, I think, is still there into that 350 range for Lululemon. Next one we want to take a look at here is Airbnb. Airbnb, we've noted this bottoming formation below 132. Bottom broke out here above this level, came back to retest this level multiple times as support, and we're looking for that continuation higher here from Airbnb. It does trade at a relatively premium valuation relative to its peers, but it is expected to grow faster than its peers and significantly more profitable. So for those reasons, I think the valuation range is reasonable, and we think that that 147, 150 upside target here is also a reasonable target to aim for on Airbnb. Bristol Myers is another one that we like in the pharmaceutical space. We've been noting about Bristol Myers ever since it broke out here above this $52 range, broke out above, came back to retest this as support, and we're looking for that continuation higher here. It trades at a very significant discount relative to its industry, despite the fact that it's expected to grow much faster. And the reason that it trades at a lower valuation is really because of impairments that they've taken over the past few years that have resulted in some net losses on their financial statements, but they're expected to return to profitability next year. And I think given the fact that it's growing faster than its peers, and it's going to return back to profitability next year, gives the upside opportunity here that exists for Bristol Myers. Another one I want to take a look at here is Meta. Meta continues to trade at a valuation that I think is reasonable for where we currently stand. And this really comes down to the fact that Meta continues to outperform in this type of market environment. So this is one that's really a bit of a tech play here that we have for Meta, is the fact that it outperforms the S&P 500, but has pulled back here to this major support level and trades at a significant discount relative to its peers. It trades at about a 20% discount relative to its peers, despite the fact that it's expected to grow significantly faster, and it is also significantly more profitable than its peers. So for those reasons, I really like Meta here as an opportunity at the moment. With that, that covers the ideas that I wanted to share with you here today. I hope that this is helpful in giving you a better understanding of how we're viewing the market, some ideas to start your week, and I hope you guys all have a safe and happy holidays for Thanksgiving, and I'll see you guys here next week.